In the United States, the world's largest and most powerful economy, trade is not just an option, but a necessity, because every single day, billions of dollars worth of goods, services, and resources flow in and out of the country, connecting it to a global system that keeps businesses running, prices stable, and lifestyles affordable. But what would happen if suddenly no country wanted to trade with the United States anymore, if exports stopped, imports disappeared, and global partners slowly cut ties? Because, at first, this might sound impossible, but understanding this, Sina RIO reveals something deeper about how modern economies actually function. Because no country, not even the United States, is truly self-sufficient, and the moment trade begins to collapse, the effects would start almost immediately, with supply chains breaking down, as the U.S. relies heavily on imports for essential goods like electronics, raw materials, pharmaceuticals, and even basic consumer products. And without these imports, shelves would begin to empty, prices would surge, and businesses that depend on foreign inputs would struggle to operate, leading to production slowdowns, layoffs, and economic uncertainty. And at the same time, U.S. exports, which support millions of jobs, would collapse as countries stop buying American products ranging from agricultural goods to technology services. And this would hit industries hard, especially those that rely on global demand, causing companies to lose revenue, reduce operations, and cut jobs, which would increase unemployment and reduce overall economic activity. And, as both imports and exports shrink, the balance of trade would shift dramatically, but more importantly, the flow of money into and out of the economy would be disrupted. Because international trade is not just about goods, it is also about capital investment, currency, stability, and financial confidence. And when global partners stop trading, they also reduce investment in U.S. markets, including stocks, bonds, and real estate, which means less capital flowing into the economy and more pressure on financial systems. And this is where the role of the U.S. dollar becomes critical, because the dollar is not just a national currency, it is the world's primary reserve currency used in global trade and finance. And if countries begin to reduce trade with the U.S., they may also reduce their reliance on the dollar, which could weaken its global dominance and lead to fluctuations in exchange rates, making imports even more expensive and increasing inflation within the country. And inflation in this scenario would not be gradual, but potentially rapid, as shortages push prices higher and reduced competition allows domestic producers to charge more, which further reduces purchasing power for consumers and increases financial stress across households. And as prices rise, wages may not keep up, leading to a decline in real income and living standards. And this creates a feedback loop where reduced consumer spending leads to lower business revenues, which leads to more layoffs and further economic contraction. And at the same time, the government would face increasing pressure to stabilize the situation through policies such as increasing spending, reducing interest rates, or implementing trade alternatives. But these solutions have limits, because without external trade, the economy loses one of its key engines of growth and efficiency. And this highlights a fundamental truth about modern economies, which is that they are deeply interconnected and dependent on each other for resources, markets, and innovation. And when this connection is disrupted, even the strongest economies can face significant challenges. Theoretical, because history has shown that countries which isolate themselves from global trade often experience slower growth, higher costs, and reduced competitiveness over time. And while the United States has a large internal market, it still benefits enormously from global trade in terms of access to cheaper goods, larger markets for exports, and opportunities for investment. And innovation in losing this access would force the country to rely more heavily on domestic production, which may not be able to meet demand efficiently or at competitive prices. And this transition would require significant time, investment, and restructuring, which would create short-term disruptions and long-term adjustments. And during this period, uncertainty would increase, affecting business confidence, investment decisions, and overall economic stability. And as confidence declines, markets may become volatile, with fluctuations in stock prices, currency values, and interest rates reflecting the uncertainty surrounding the future of the economy. And this uncertainty can have real-world effects as businesses delay expansion, consumers reduce spending, and investors seek safer assets, which slows down economic activity even further. And this is how a trade breakdown can quickly evolve into a broader economic crisis, affecting not just one sector, but the entire system. And as the situation develops, the United States would need to make critical decisions about how to respond, whether by rebuilding trade relationships, diversifying supply chains, investing in domestic industries, or adapting to a more self-reliant economic model. And each of these options comes with trade-offs, challenges, and long-term implications that could reshape the economy in fundamental ways. And this is where the real question emerges, not just what happens when no one wants to trade with you, but how an economy adapts, survives, and potentially transforms in response to such a shock. And this is where the story truly begins. But to truly understand what happens when no one wants to trade with you, we need to look beyond theory and into reality, because this is not just a hypothetical situation, it has already happened. To countries like Argentina, where years of economic instability, high inflation, and policy uncertainty slowly destroyed global trust, and once that trust was gone, international trade and investment started drying up, which pushed the economy into a dangerous cycle. Because when countries stop trusting the economy, they stop lending money, they stop investing, and they reduce trade relationships, which immediately limits your access to foreign currency. And this is where the real crisis begins, because without foreign currency, especially US dollars, it becomes extremely difficult to pay for imports. And when imports are restricted, shortages begin to appear across essential sectors including fuel, medicine, technology, and industrial inputs, and this creates a ripple effect where industries that rely on these imports cannot operate efficiently, leading to reduced production, job losses, and further economic contraction. And at the same time, inflation starts to rise rapidly because fewer goods are available in the market, while demand remains the same or even increases, and this imbalance pushes prices higher, which reduces purchasing power and forces people to spend more just to maintain basic living standards. And as inflation accelerates, confidence in the local currency begins to collapse because people no longer trust that their money will hold value over time, so they start converting their savings into more stable currencies or assets, which further weakens the currency and increases inflation, creating a vicious cycle that becomes extremely difficult to control. And this is exactly what happened in Argentina, where inflation reached extremely high levels and the local currency lost significant value, causing everyday life to become more expensive, unpredictable, and stressful. And as this situation continues, the government often tries to intervene by implementing policies such as price controls, currency restrictions, or increased money printing to stabilize the economy.